A couple of months ago, I made a video sharply criticizing YieldMax ETFs. And it turns out that when you dunk on YieldMax, you're kind of kicking a hornet's nest. YieldMax fanboys came out of nowhere, occasionally with a reasonable rebuttal, a lot of times with complete nonsense. A lot of you guys are really serious about these investments, almost cult-like in your defensiveness. And you get really upset when people insult YieldMax. I want you YieldMax fans to understand something. I do not hate you. I do not want your investment to fail. I do not wish ill upon you. And this video is not an I told you so, now that YieldMax is really starting to dump. I just want the people going down with this ship to wake up. I think you made a bad investment. I think YieldMax did a great job marketing these deceptive ETFs with a siren song promising huge yields so that they can make money off their management fees. And you guys bought the snake oil. That's all this is. In fact, I'll go as far as to say that I hope YieldMax fans are right and I'm wrong. Because if there really were a financial instrument that can consistently yield me 60% annually, I'll take my Mikey Millions money and dump it into those funds and never have to think about money again. But that's not what YieldMax is, and it's time for you guys to wake up. To set the stage a little bit, my argument against YieldMax ETFs boiled down to a few points. One, these ETFs are just covered calls on high volatility stocks with high management fees. That's all they are. Covered calls on high volatility stocks are a guaranteed way to get crushed when the underlying drops with no means of recovering share price. YieldMax is not adequately rewarding you for your risk. Number two, forget outperforming your underlying. You will almost always underperform the underlying stock over any appreciable time period. And number three, your distributions from these ETFs will continue to decline over time with little prospect of increasing. As evidence, I showed how the popular YieldMax ETFs like NVDY, PLTY, and HOOY are all getting smoked by their underlying shares. NVDY shareholders boast of their amazing returns while also getting lapped twice by shares of Nvidia. I also showed several distribution tables demonstrating how YieldMax ETFs keep paying lower and lower dividends as the share price drops. I pointed out how Finfluencers who post their amazing YieldMax distributions always seem to leave out how much they lost in share price during this time. How making $1.01 in dividend came at the cost of $2.08 in share price. I predicted that all of these ETFs will eventually go the way of Tesla, which has been squashed in share price, distributions are down to a sixth of what they used to be, and it's so grossly underperforming its underlying that it's embarrassing. It's even doing a second reverse split just to keep its share price safe from delisting. And yet, I don't think that video in September changed any minds. People who were already agreeing with me were further convinced. People who, like YieldMax, dug their heels in and rejected the evidence. I think it's remarkable that when I talk about how the share price on these ETFs keeps dropping too fast to sustain your portfolio value, you guys always say that doesn't matter and you only care about total return. And then when I show you how YieldMax ETFs are getting smoked in total return, you guys suddenly don't care about total return. And then you talk about how the only thing you care about are the distributions. And then when I show you the distributions dropping each month, suddenly you don't really care about the distributions in raw numbers and only care that eventually you'll get paid your principal back, and then you can ride the zero basis position of house money or some other rigmarole. Rather than actually defend the ETFs, you guys just keep backpedaling and clinging to something. But in recent months, even the most committed YieldMax people are disappointed with how these funds are doing. And deep down, you all know that YieldMax ETFs are not all they were cracked up to be. For those new to the channel, I'm Mikey Millions, and I've been a critic of YieldMax since I learned about them several months ago. I'm not going to do your thinking for you and tell you how to invest, but I do hope that with this video, I can arm the YieldMax holdouts with some information so that they can manage their investments from an informed position. But my favorite way to make money is to get something for free, which is a rarity in this world. So allow me to introduce Moomoo, the sponsor of this video, who wants to hook you up with up to $1,100 of shares and cash vouchers. Moomoo is running a special promotion in which new users receive up to $1,000 in Nvidia shares and 8.1% APY on cash for 3 months. And just for Kamikaze Cash viewers, an additional $100 cash bonus as well. Rewards are based on the amount you deposit, from $100 up to $50,000. Whatever you go for, I recommend leaving your deposit as cash until the bonus shares vest. That way, you don't get bumped into a lower tier if you trade like garbage and lose money. Beyond the free share promotions, Moomoo has been surprisingly good as a broker. I've been with them for a few years, trading is as smooth as anywhere else, and participating in their recurring paper trade events yields merch and cash vouchers that you just can't get anywhere else. And their desktop tools are way more useful than they've been given credit for. Their stock overlays made it significantly easier to make this video. Join now with my link in the description to make sure that you get the additional bonus. Thank you to Moomoo for sponsoring, and now let's get back to roasting YieldMax. If you had asked the Finfluencers 3 months ago what the secret to passive income and retiring early is, they would have pointed you straight to the covered call ETFs, especially those from YieldMax. What could be better than a passive investment yielding you over 50% annual return, or sometimes even more than that? We've got High Yield Hustle in August telling his followers that a $100,000 investment into Ulti would be a passive income stream of $80,000. All that nonsense about the 4% safe withdrawal rate is old and obsolete info designed for the boomer generation. Real FIRE investors are all about cash flow, and pulling 80% yield per year would get you to the promised land. So skip investing in VOO for 40 years. Just grab a bunch of YieldMax ETFs and you're done. That sounds great. It sounds like he's doing YieldMax's marketing for them, but it didn't really work out. If you had put $100,000 into Ulti on the day of that post, you'd be down about 9% as of mid-November, including your dividends. And if you reinvested your dividends, you'd be down even more, down 11.3%. And that $80,000 annual dividend projection might need to be revised down a little bit. Instead of paying about 10 cents a share in distribution like they were in August, the weekly payouts are spiraling pretty badly, and now you're getting a little over 6 cents, a downtrend which is more than a little concerning. Meanwhile, the share price itself is down 80%, and the ETF has to do a reverse split to avoid becoming a penny stock. And this is not the exception. Look at Misty, the MicroStrategy covered call ETF, another one of the YieldMax darlings that everyone was bragging about just a few months ago. It's a good thing we didn't listen to Jeff Walton in April talking about how retirees should put $1 million into Misty for passive income. He tried to make conservative estimates by assuming that the share price would drop 20% per year while paying out 50% distributions. During that time, the retiree could reinvest beyond their income need. Well, if anyone did that, they'd be down about $300,000 as of mid-November. I think Jeff was a little optimistic about Misty losing only 20% per year, given the stock is now down 83%. A covered call ETF is not going to climb back up if MicroStrategy itself recovers. And the monthly dividend is about 18% of what it was when he posted. Misty shareholders lost 82% of their dividend stream this year, while the stock is down 83%. ABNY with Airbnb as the underlying, down 40%. AMZY with Amazon as the underlying, down 30%. This is a common problem. But I'll be fair, HOOY shares are only down about 1% since inception in May, and including dividends, you're up a good amount, 80% gains. That's pretty good until you realize you're missing another 46% on your investment if you had just held shares instead of covered calls. With very few exceptions like HOOY, these ETFs have come up really short of everyone's expectations, with share prices cratering. Come on, Slick. None of us care about the share price. These ETFs are going to pay me my whole life for doing nothing. I'm building a cash-flowing machine. YieldMax is like owning a rental property or having an annuity or buying a CEO's salary. Thank you, Slick Mikey, but I completely disagree. People have been using this analogy for a while, but it simply does not hold water. I don't think these ETFs are anything like owning a rental property, having an annuity, or having a CEO's salary. If I have rental property, I expect the value of that property to increase over time while rent increases whenever the tenants turn over. Even in the 2008 to 2011 global financial crisis, that only knocked home prices down 33%. Misty lost that much over the past couple of weeks. If I have an annuity, I expect the payments to be the same every month. And if I'm a CEO, I expect my compensation to increase annually or at least stay the same. You don't get any of that with YieldMax. What you get instead is a continuously declining principal value paired with a continuously declining distribution. I spent a good amount of time looking, and I even asked ChatGPT for help, and I could not find a single YieldMax ETF where the distributions have actually gone up. This idea that a lump sum of $200,000 into a covered call ETF yielding you $100,000 per year in cash flow is nonsense. With only a few exceptions, all of them will show a steep decline. Misty is the largest of the YieldMax ETFs in terms of assets under management. And like I stated prior, distributions are down about 80%. TSLY is the fourth largest, and it's been in continuous decline. Ulti is in this irredeemable death spiral. Coney is getting hammered. Of the top 10 YieldMax ETFs by assets under management, only YMAG and NVDY are showing the ability to sustain distributions, and that's because NVIDIA is the undisputed market leader of 2025. NVDY is still down 42.6% over the past year though, so those distributions will have to break eventually. Almost all YieldMax ETFs are dramatically reducing their payouts, often by over 70%. You should never have a rental unit, annuity, or salary that decreases 70%. The idea of putting up this large initial investment and getting a doctor's salary is lovely until reality kicks in and you realize that it was all a fugazi. Here's the hard truth, and one that you guys are not going to like. The reason YieldMax can't sustain 80% yields is because covered calls don't make 80% returns. According to YieldMax's own annual reporting, the cumulative gain and loss of its initial 29 ETFs since November 22, this is the gain that they made from selling covered calls, is about $643 million. During that time, they paid distributions of $5.4 billion. They are not even close to making enough money selling covered calls to pay their dividends. How are they paying $5.4 billion in distribution while making only $643 million from covered calls? Where does that extra $4.8 billion of excess come from? It comes from you. YieldMax liquidates the assets their investors bought, and they use the proceeds to pay the distributions. That's why you see return of capital distributions while the ETF loses 60% of its net asset value. They are liquidating and returning your capital. The covered call strategy never earned enough to pay the yields that they advertised. So they just quietly sell your assets every month to keep the illusion and charge you fees for the privilege. Keep that ROC thing in mind for later. We're going to talk more about that one.
Listen to me, Washichu. You say distributions keep dropping, but you're forgetting one key point. I don't just take the money and run. I reinvest the dividends into more shares. That's called a DRIP, the Dividend Reinvestment Plan. So even if the dividend from a single share drops, I got more shares earning more dividends each month. What do you say to that?
Chief Mikey brings up an interesting point that a lot of Finfluencers and even YieldMax itself recommend. Since YieldMax distributions do indeed seem to go down over time, and to a significant degree, some people have tried to work out a solution to their ever-decreasing payouts. Rather than just withdraw the money, they take a portion or even all of their YieldMax distribution and use it to buy more shares of covered call ETFs. So if you own 10,000 shares of Ulti and receive $625 of dividend this week, you'll use that to buy 150 more shares. If the distribution is the same next week, you'd get $632, so $7 more than you did the week prior. Chief Mikey and others like him believe that this reinvestment will help float your returns, so that even if your distributions drop on a per-share basis, your overall payouts will stay the same or rise. There are occasions where this works. If you look at a particularly strong example like PLTY, the Palantir covered call ETF, reinvesting your dividends did indeed help, because Palantir shares have continued rising, and so reinvesting your dividends into PLTY has helped you along the way. But when you look at something like MRNY, the Moderna ETF, dripping your distributions worked against you because you were putting your money back into a decaying fund with a negative total yield. In simple terms, if your ETF's total return stays positive, then dripping will help you. And if the total return is negative, then dripping will work against you. You must keep in mind that covered call ETFs are fragile. You cap your upside while still losing money when the underlying stock drops. So let's assess Coney, the Coinbase ETF. Both shareholders dropped in $10,000 in September 2023. One shareholder drips his dividends like Chief Mikey recommends, and the other just takes the distribution every month and spends it at the nightclub. For a while, the drip investor was doing great. Look at this outperformance by July 2025. By reinvesting all of his money, he was killing it. But Coinbase stock has dropped recently. In terms of total return, the non-drip investor who has been leaving his money in cash now has the exact same amount of money as the guy who never spent anything and just reinvested all of it back into Coney. And if this non-drip investor were earning any yield on his savings, he's now outperforming the dripper. The results are even worse for Misty, the largest YieldMax ETF by AUM. Despite a year of outperformance, the drip investor, who only reinvested everything, now has less money than the guy who never reinvested at all. And old trusty Ulti really demonstrates the point very well. I'm all but certain that the drip investor will be underperforming the non-dripper by the time I publish this video, and both investors will have a loss in total return. By dripping, you're increasing exposure to the ETF. So when NAV decay happens, and it will, then you will lose years of returns to a much steeper degree than if you never reinvested. Reinvesting your covered call dividends is borrowed time, and this all boils down to YieldMax's covered calls not making enough money to pay the distributions on their own. They must crack into NAV to pay you a return of capital, and by dripping, you're adding more exposure to that sinking ship. The final note I'll make to this point is that if you're reinvesting all of your dividends, you don't really need the dividends. You're just trying to manufacture growth out of an income instrument. And in every example I looked at, the YieldMax investor dripping his distributions would have been better off just holding shares of the underlying stock for growth.
Habibi, how can you say that YieldMax is on borrowed time? I bought Nvidia at inception in October 2023, and I'm up over 200%, mashallah. If that's not enough reward for my risk, I'd hate to see what is.
Respect to Habibi here. Traders who bought NVDY, PLTY, or HOOY, and all the other really strong performers nailed one of the best trades of the post-2022 era. You bought into companies that people doubted or didn't understand, and you crushed it. You hit a bullseye by buying one of the best performing stocks ever at exactly the right time. And then you sold your upside. You picked one of the best stocks of the decade at an amazing price, and then you gave someone else the rights to your gains. Habibi says that he bought NVDY in October 2023. I'm going to say the same thing a different way. Habibi has been selling covered calls on Nvidia since October 2023. While Habibi nailed a great trade here with 270% returns, those covered calls were extremely costly. NVDY lost money rolling those covered calls as Nvidia kept climbing higher. And Habibi, as the NVDY shareholder, suffered a significant drag. If he had just purchased Nvidia shares, he'd be up almost double where he's at now with 525% gains. Or looked at another way, if he sold 40% of his Nvidia shares to buy a Cybertruck, he'd still have more money than the guy who bought NVDY shares. PLTY, another great example. PLTY is up 160% in total return. That's fantastic. But Palantir shares are up 332% return. That's more than double. Now, I can understand accepting some level of underperformance in exchange for having someone else manage your covered calls for you. If PLTY were generally keeping up with Palantir, maybe 300% return instead of 160%, then I could understand. But the PLTY shareholder made half as much as the Palantir shareholder. Is that adequate for you? Think of it this way. Someone who put $100,000 into PLTY has less return than the guy who put $50,000 into Palantir and spent the other $50,000 to improve his quality of life. Are you willing to accept half as much gain in a bull market? Maybe. But if you tell me that you're happy with PLTY versus PLTR, I think you're fooling yourself and no one else. And this pattern is true for many of the high flyers. Here's Google versus GOOY. The YieldMax ETF shareholder got 50% as much gain. I could not find a single YieldMax ETF that has outperformed its underlying. And that means you are taking on almost the same risk as the underlying shareholder with significantly less reward.
Yo, Hosh, think about the longer term here. Eventually, this ETF is going to pay me my whole investment back in dividends. Once that happens, I'm riding house money. That's free cash flow for life, compadre. House money means that even if the ETF drops to zero, I still broke even. I'll take that cash flow every day of my life. House money.
Haas Mikey is echoing something I hear people say all the time. This idea that no matter what happens in the near term, these distributions from the YieldMax ETFs will eventually pay you back 100% of your principal investment. At that point, you cannot lose money. You just get this flow of dividends. And people imagine this long string of zero-basis ETFs where they're collecting dividends from Misty, Alti, Pulte, NVDY, and so on. I understand the appeal here. Everyone thinks about this when they first discover covered calls, including me back when I was Mikey Thousands. Riding house money sounds like a magic bullet. But every single time, without fail, reality will fall far short of the dream. The first problem with this house money dream is that it is purely psychological. Getting 100% of your money back as dividends is the same thing as doubling your investment. What Haas Mikey just said is, I want to get 100% return so I can cash out my initial investment and ride the rest. Getting your principal back from distributions is the same thing as getting 100% return on your investment and selling half. And when you're talking about YieldMax ETFs that actually have paid 100% of their inception price back to shareholders as dividend, all of them took way longer to reach that milestone than shareholders who just bought the underlying stock and sold half. For example, let's look at Darkminer, who celebrated in early November that his Coney dividends just exceeded 100% of his principal investment. He now anticipates a free income stream for life from here. Here's where we see problem number one with this house money illusion. Let's look at Coney versus Coinbase. Darkminer says that he started purchasing in October 2023, and his goal was to reach that house money situation, 100% of his principal returned as dividend. This goal ended up being a huge disservice to him. Because what he didn't realize is that Coinbase's huge rally that winter meant that both he and the Coinbase shareholder were up 100% before Christmas. A Coinbase shareholder looking for that free ride could have closed out half of his position already and in the span of 2 months reached house money. The Coney shareholder could have done the same. Coney reached 100% return just a week later. But this house money goal blinded Darkminer and those like him into continuing to hold. By the time Darkminer posted his house money milestone in November 2025, another 2 years had gone by. Darkminer's goal of riding house money caused him to earn nothing in total return between December 2023 and November 2025. During that time, the Coinbase shareholder doubled his money again. Now, that said, he did get his house money, and now at long last he gets to enjoy his stream of dividends. But that gets us to problem number 2. Even after you reach house money, that supposedly everlasting stream of dividends will keep getting smaller. At this long-awaited house money level, Darkminer is getting 40 cents per share per month in dividend, down from $1 per share per month at the beginning of the year. That's a 60% decrease. This pattern is not going to turn around, and Coney will be paying 4 cents a share soon, notwithstanding its reverse split. This idea of perpetual house money dividends is not real. That river lost 60% of its distributions in the last 12 months, and it will continue getting thinner. House money is not a long-term dividend stream. Give it a year and you'll barely be receiving a trickle. I want to show that this isn't unique to Coney. The strongest example I could find of house money almost working is in NVDY. A trader who bought at inception in May 2023 would have received a 100% return by April of 2024, only 11 months later. That's not too much worse than the Nvidia shareholder who reached house money only 3 months earlier in January. But just like what happened to the Coney shareholder, the NVDY river of dividends didn't quite materialize. When he reached house money, the NVDY shareholder was getting $2.60 per share. Today that's 72 cents. That's 73% less dividend than when he reached that house money level. And keep in mind, this is a really good performance from one of the best funds. NVDY was the strongest YieldMax performer on the board, and its payouts still looked like this. I can understand the appeal of having that free ride, but it is not this perpetual income stream that people envision. At best, you're getting a drying income stream that loses 75% of its value per year. And let's not forget, once you do reach house money, you have to pay taxes on your return of capital distributions. So add in that tax drag, and you're getting even less than it initially appears.
Habibi, you're making the mistake of treating everyone as though they bought their ETF at inception. There have been major dips in the share price, and if you buy the dips, you're much greener than these haram visuals will show you.
What Habibi says is true. AMDY is a good example of this. The stock has been very volatile, and if you bought the dip in April, you're in pretty good shape. You'd even be up in share price while also receiving the dividends along the way. That's really good trading. You're not even that far behind AMD. On a stock that did very well like Palantir, you're still leaving much more on the table, in this case 30% more, but your return is still respectable. Nevertheless, in this type of short-term trading, the covered call aspect of the YieldMax ETFs means that your upside is capped. So if you're buying the dips on AMDY, what you're really telling me is that you sold covered calls on AMD at the bottom. If you sell covered calls at the bottom, you're going to make money. But since your upside is capped, you made less money than if you just didn't sell the covered calls and bought shares instead. But to be fair to Habibi, I understand why someone might sell covered calls while a stock is low. It could go lower still, and it's nice to have that premium coming in to offset that further decline in share price. We can see that for those who bought the dip on MicroStrategy in January. The Misty shareholder, so covered call position, lost less than half as much as the MicroStrategy buyer until the stock bottomed in February, because the covered call income helped cushion that loss. If that's your strategy, that's fine. I'm not going to argue against buy low, sell high as an investment strategy. I would just encourage you to look at your actual performance based on your purchase dates and compare your returns from selling covered calls on the dips to just buying shares of the underlying on the dips. Compare your performance and then decide if you should continue or switch to regular shares with your buy low, sell high approach.
Comrade, you're still missing the point. That garbage you guys recommend like SCHD, Triple Q, and VIG, all trash. Look how much Ulti paid me in total return and compare it to SCHD. It's night and day.
Comrade Mikey is making an argument that people were talking about for a while. Here's Bitcoin Tej showing you how $95,000 into Ulti brought you 10 times as much total return as $3 million into SCHD. And Misty was just sweeping the board with everyone. This is a fun data point, but his 12 months of data show a lot of bias. A lot of these YieldMax funds started in 2023. We were just climbing out of the first real bear market since the Great Recession, and high volatility stocks were just sailing. YieldMax picked the absolute best time to start marketing these funds because the underlyings were all ripping. Speculation was back. Look at the underlyings of Ulti. We got data centers, crypto processors, AI, and fintech disruptors. This is all high-risk stuff that moves significantly more than the market. In 2023 to 25, that raging bull market is the absolute best time to own these stocks. If you're invested in this, you'd better be making more money than SCHD's consumer staples. But let's do this exact same comparison as of late November. From the same starting point as Bitcoin TEJ, we can see that the leader Misty has lost all of its return, and all that praise he gave to Misty is worth nothing. Misty, Ulti, and SCHD are all the same in total return. And if you bought at the beginning of the year, SCHD is beating Ulti and Misty and within 1% of YieldMax. HOOY, that's Robinhood, is the only one still with a sizable lead. All it took was for the S&P to go down 5% for all of these high volatility stocks to faceplant. All that praise for Ulti and the trash talk on the other funds, and now Ulti is smoked. So while it's true that Ulti will give you a larger distribution than SCHD, once you look at the total return, none of that matters. You could have put your money into a zero yield savings account, made withdrawals equal to Ulti's distributions, and you would have still wound up with more money than an Ulti shareholder. Here's the difference between dividend ETFs like SCHD and covered call ETFs like Ulti. Dividend ETFs actually earn what they pay you. SCHD receives dividend from its underlying shares like Coca-Cola and Chevron, and then redistributes those dividends to you. Ulti does not hold shares. It's all synthetic positions, and so it does not receive dividend. It sells covered calls to earn money to pay you, but those covered calls aren't generating nearly enough money to pay their distributions. So every month, they sell off some of their positions and use that liquidity to pay you a distribution. Ulti and other YieldMax funds give you this illusion of high yields, but it's really just your own money coming back to you. Meanwhile, SCHD offers you no illusion. It pays a lower yield because its dividend yield is real, not imaginary.
I can
Guys. I know. Everyone has this magical approach they want to use to explain how, with their very specific method, YieldMax is good. There is some use to covered calls. I sometimes sell covered calls. I sell out of the money strikes when volatility is high. I close early for a gain. You don't win them all, but you do a lot better than constant NAV decay with yield drying up. If learning how to sell covered calls is not what you want to do, but you still want dividend income, that can be arranged. There are better options out there. The hated SCHD is one of them. SPHD also works. JEPQ and VIG are fine, and QQI is a little more aggressive, but it is a valid instrument. You could have $6,000 a month in dividend. It will just take you longer to save enough money. But with the right ETFs and shares, it'll have staying power. But you can't get this by doing this. Please do not dump paychecks into covered calls on MicroStrategy. Do not liquidate your mother's 401k to trade YieldMax ETFs on margin. And don't even get me started on the fund of funds scams like YieldMax, where you pay a management fee to hold funds that all have their own management fees from YieldMax. It's just fees on fees. All this to say, there is nothing sustainable about YieldMax, and it's time to move on. YieldMax is happy. They got their management fees. Shareholders got deceived into paying a fee to get their own money back in return of capital distributions. Now YieldMax is pushing out a new ETF every week. But YieldMax ETFs were never designed to be good for investors. They were just designed to be good for YieldMax. If you're still in, it's probably time to move on. But if you think I'm an idiot, that's fine. I said my piece. I hope you're right and you can prove me wrong so that I can tap in myself. But don't let pride stop you from doing the obvious thing here. And that's to abandon the YieldMax management and make them fund their own covered calls. I look forward to your comments, and don't hesitate to check out our free Discord link down below. Thank you all for watching, and I'll see you next time.